Hi there. I've been asked to do a short explanation on what on earth is going on between what are called the bedroom traders, uh, small stocks like GameStop, and now the silver market, and how is Robinhood involved, and what is the role of uh, august institutions like Goldman Sachs, JP Morgan, and uh, of course the Cohen hedge fund. Now, the mechanism is quite simple. It is that a group of individual investors who don't actually have a lot of money get together by kind of summoning each other, rather like they were going to organize a demonstration or a protest march on a platform called Reddit. And they agree among themselves to buy a small and a liquid asset. That can be Robinhood or even the silver market, which it may surprise people, but compared to the gold market or market in big stocks is always very illiquid and often subject, in my view, to manipulation. So all these guys, usually I'd say, and gals with an age of under 25, put together their hundreds or a couple of thousand US dollars equivalent and go out and buy a small stock. In this case, I'm going to focus on the small stock, which was GameStop. Now, GameStop is a company which sells computer games, as I understand it, on through a physical retail outlets on the street. Now, that's a dying business, like Netflix was. Not like Netflix, but like the old video distributors were. We used to sell you videos to take home and watch. It's a dying business because obviously a video online game is best sold online. But because the stock was small, cheap, it was a perfect target for what is a relatively small amount of money in total put together by the bedroom traders of Reddit, but which in relation to the market capitalization of that stock, which had declined a lot over the years, it was a very big amount of money. So the result was that the GameStop stock climbed 300-400%. And the Reddit individual investors made that sort of a gain. Well, that's fine. You might say that's how stock markets actually work. They may be speculative, but speculation is a part of the action of a free market capitalist system and its markets. But it wasn't the end of the story. The story had another chapter to it, which is that a very large hedge fund, or several large hedge funds, one of them known by its eponymous founder, Cohen, was actually short the same stock. They were short Robinhood. They weren't only short the same stock to 100% of the issued stock, they actually were short about 130% of the issued stock. So how does that work? Well, hedge funds short a stock because they actually take on this stock onto their book as a short position at a price of, say, 100. They predict that price is going to fall to 50. And when it does fall to 50, then they will make the difference between the 50 market price when they close out that short and the 100 market price at which they put on that short and make 50 per stock and put it in their pocket. But unfortunately, sometimes this doesn't work. And in the case of what we're looking at today, the phenomenon we're looking at today, of course, the Reddit investors pushed the stock price up by 300-400%, leaving the hedge fund or funds with losses on their short book in the same stock of the order of between 30 and double the figure billion US dollars. Now, at that point in time, there was a danger, of course, that some of these hedge funds, without being specific, could collapse. And if they collapse, of course, the loans that they have from the banks will go sour. And the banks don't like that. And in a highly frothy market like we are today, you could get knock-on effects which would cause a financial crisis. So what happened next? Okay, what happened next was the good angels, those very, very, very large financial institutions like JP Morgan and Goldman Sachs decided, well, we don't like this very much. There's a bit of a danger here. We could have a financial crisis, and financial crises are terribly bad for banks and, of course, extremely bad for bankers' bonuses. So they stepped in. Now, how do they step in? Well, as I've told you, the individual traders have bought a load of a GameStop stock. That sits in the broker, which carries out these operations on the broker's accounts. That broker is called Robinhood. So Robinhood has a whole load of GameStop stocks, which the individual traders actually own. But being a broker, Robinhood can lend those stocks. That's how financial markets work. You lend what you don't own. So the Robinhood organization lent those stocks to JP Morgan and to Goldman Sachs. And in return, they get paid for lending stock. Now, this is a standard practice in financial markets, by the way. It's not any more jiggery-pokery than the whole financial system is jiggery-pokery at the best of times, but it goes on all the time. So JP Morgan and Goldman Sachs have now borrowed these stocks from Robinhood, and Robinhood is earning income by lending those stocks. And what did JP Morgan do? Well, JP Morgan and Robinhood actually lend those stocks to the hedge funds who are short the stocks. So they close out in whole or in part through these repo operations, meaning that eventually they have to be closed out and the stocks have to be returned to those that they belong. They were able to give those hedge funds enough of GameStop stocks to close out a substantial part of the short position. So the financial crisis was actually assuaged by the hole being plugged by stocks which were borrowed by JP Morgan and by Goldman Sachs from the broker Robinhood and lent to the hedge funds who were short GameStop stocks in the beginning. Now, that you say that's very odd. Well, yes, it kind of is odd in the sense that the stocks which have removed or lessened the shorts in the hedge funds don't belong to the people who lent them to the hedge funds in the first place, and they certainly don't belong to the hedge funds. But unless, if you think it out, unless the initial investors, that is the bedroom investors, actually sell the stock, thereby driving down the price, of course, and diminishing their own returns, unless they actually sell the stock, this game can go on. Because unless the stock is sold and the positions with the broker Robinhood are closed out by the game room investors, then essentially the stocks will stay in Robinhood, the broker. They will continue to be lent to JP Morgan and to Goldman Sachs, who will continue to lend them to the hedge funds, who will continue to have enough stocks in their books to cover a substantial part of their shorts. However, it hasn't covered all of their shorts. There is rumored still to be about 30% of the total outstanding amount of GameStop stocks, which have actually have not been covered. So there could be, 20, 30 billion hole in hedge funds. Would that bring down the hedge funds? I doubt it. I think those hedge funds would trot along again to their favorite lender, their big bank friend in Goldman Sachs or JP Morgan or wherever, and they would get a loan for that amount of money. So capitalism lives to fight another day. You may find this awfully roundabouty way of doing business, but then capitalism is a very roundabouty way of doing business, and this is how you are. Now, the conclusions from this, there are a couple of conclusions we want to get straight. The first conclusion is that this is not like a yellow revolution in Eastern Europe, where these worthy individuals, small people, normally very young people, have got together to take on the wicked hedge funds that run the world, which of course is a phantasmal notation. They don't, but it's not like this is an ethical and moral revolution like protests on the street of Hong Kong or overturning a corrupt government in Ukraine. Not at all. This is purely to make money. So the motivation behind this is the same as capitalism itself, to make a quick turn on something where speculation has to do with the turn and fundamental analysis has nothing, because these individual investors, the bedroom investors, know absolutely nothing about the fundamental value of GameStop and care less. First thing to say. The second thing to say, the amount of money they put together is really quite limited and will only work in markets which have 100, 200 billion capitalization. The reason for that is because these individual investors do not have access to big credit, unlike the hedge funds, who can get huge amounts of credit and huge amounts of measures to actually reduce their leverage if they get into a sticky situation like today. These guys have, these individual investors have nothing, very little. They might get a mortgage to buy a flat, but that's about it. So they cannot muster the firepower to take their disruption of financial markets to really big assets which matter, like, for instance, sovereign bonds. But of course, the techniques used could be taken on board by nefarious international powers or other entities who might be able to motivate them for that purpose. But this lot of people, certainly not. And third of all, and the most important conclusion of all, the reason why this is working is because individual investment is in stock markets is extremely frothy. Stock markets in general are very frothy. And at the peak of every stock market cycle, before it crashes, you get the massive activity, herd activity of individual investors. And now we've got it again. So if there was an overriding lesson I would take from this, it is that actually this may be a danger sign without being the real and present danger itself. It may be telling us something about the nature, psychology, and mentality of investments and investors and markets at the moment, which is something we want to take into account because it is a danger signal. Thank you.